Thank you all for coming it's early in the morning. So I'll draw your attention to our disclaimer, which is you can read at your leisure. Maybe three key themes I'd like you to leave with here for this business. We are a company in the middle of, we have a very solid foundation. We have a mature asset that is a great cash generative producer. It makes us very good money. It's been a fantastic investment. We've had it for 14 years. We've been paying a dividend for 7 years, which frankly is a little unusual for a company of our size. We have some very near-term and de-risked growth in the business. We'll be growing production by about 40% over the next 2 years, so that's quite exciting. And most of that hard, heavy lifting has actually already been done. And then we believe we're operating in one of the last gold frontiers in Africa, in a region that's had no proper exploration investment for probably definitely the last 30 years, but probably arguably even the last 50 years. And there's plenty of gold in the ground. So just a brief summary of the size of our business. We operate the Blanket Gold Mine south of Bulawayo in Zimbabwe. It's a mine we bought of Kinross in 2006. It's a 55,000 ounce a year producer. We're in the process of investing quite heavily in that business, and we've been doing so for the last 5 years to grow that production up to 80,000 ounces by 2021. Got about 1.8 million ounces of resource, roughly 15 years of mine life. Pretty well cashed up, $8 million in the bank in September. That's probably a little bit higher by now. And we pay a dividend, as I said. The yield's probably closer to 3% now because the share price has been running fairly hard. Some operating statistics. Again, this presentation will be on our website. The numbers I draw your attention to are operating cash flow there. So we're a $120 million market cap business. And 2016, 2017, 2018, after-tax operating cash flow, $23 million, $25 million, $18 million. 19 will be roughly similar to those numbers. This business is very, very profitable and cash generative. But capital investment's been high. We've been spending most of those profits on a new shaft, which takes us down to 1.2 kilometers to grow production and to extend the life of the asset. That capital investment is coming to an end, and I'll explain that shortly. We've had a string of good news lately. So from July last year, we finished the shaft sinking, which was the main, where most of our investment was going. We've had pleasing improvement in the stability of electricity supply in Zimbabwe following a very difficult sort of quarter 2 and 3. We increased our dividend in January of this year. Then we had a production record in the fourth quarter, which we announced. So a couple of very good news. And then just last week, the opposite of a profit warning, which is always nice. Our capital structure you can view at your leisure. We've had a pretty good run over the last few years compared to the GDXJ, which is where we benchmark ourselves. Most of that outperformance has actually come from the dividend. So when you pay a dividend consistently for 7 years, the compounding effect over time is quite helpful. This is our resource base. So we're sitting, as I said, with about 1.8 million ounces of gold. It's, we're certainly not resource constrained as a business, and we've grown that resource base every year since 2012, despite having mined about probably 300,000 ounces of production over this time. So as I said, we have a near-term growth project. We've been investing since 2015, was when the heavy investment started. So 2015 and our last year of heavy lifting in terms of that investment is 2020. We've been sinking a brand new shaft. That's the sinking headgear you can see there. It's going to take our production up to 80,000 ounces, and it will get our operating cost down to somewhere between $700 and $800 an ounce, and importantly, extend the life. This is a very deep ore body that keeps going deeper and deeper, and you've got to keep investing to make sure that you can maintain that production level. So what you're looking at here is a long section, so a vertical slice through the mine from surface down to, that's a depth of about 1.5 kilometers in total. And that's about 3 kilometers of strike. So left to right is the north to south along the mine. And you can see the grey stuff is the mined out stuff. This is a mine that's been running for 114 years. It's a lot of the ore body's been mined out, and the coloured areas, which are measured and indicated and inferred resources, plus some of the reserves, most of them are deeper. Right? You can see there that is our 750-meter constraint. So the infrastructure we bought off Kinross in 2006, that is constrained to 750 meters, and we've got to go deeper, and that's where the new shaft is. So the new shaft comes in. I'll show you that now. So that is the main production shaft, 4 shaft, which is, as I said, constrained to 750 meters. It's served us very well. It's given us a good 12, 13 years of mine life, but it's getting tired, and we're running out of ore at those depths, and we've got to keep investing in to keep sustained production. That's the Jethro Shaft, which is where our men go down. So the men go down Jethro on the far right. They then walk along, possibly go down deeper down another subvertical shaft, which is the only area we can get below 750 meters. But importantly, you can see there, the men come down there, then have to walk probably 3 kilometers. It can take you 2 hours to get to the rock face. This is not how you would build a mine if you were building it from scratch. That's the central shaft. That's where all the money's been going. So we've been spending $20 million a year for the last 5 years. We've got 1 more year to go. Well, we've got 6 months to go, really. We commission this thing in about October, and then we ramp up production from there. It opens up 3 new operating levels at depth. We're very excited about this. It's a much more efficient operation. It really transforms the mine and gets our production up to 80,000 ounces. And 80,000 ounces is where the maths gets easy, right? 80,000 ounces, all-in sustaining cost of about $700 to $800 an ounce. We think we'll get to the low end of that. That's an operating margin at today's gold price of about $800 an ounce. That's $64 million of EBITDA. We're a $120 million market cap business, and we've got about $10 million in the bank. So, that's some pictures of what it looks like at the moment. Like I say, we commissioned this in October, so it's an exciting inflection point for the business. But this is really, I think, if you remember nothing else, this is what the fundamental investment case here is. That is straight out of our cash flow statement. So you're looking at light grey bars are operating cash flow after tax. If you look in our cash flow statement, you'll see those. So that's the historic data, actual numbers from 2018. We haven't published 2019 yet, so those are estimated numbers, but this comes out from a technical report that's available on our website. And then the dark grey numbers are CapEx, right? So when we commission the shaft, which is happening this year, 2 things happen. Operating cash flow goes up, and capital investment goes down, and we have this growing, expanding level of free cash flow as we go forward. This is done at $1,275 an ounce, which is where the technical report was done. You can do the maths for yourself. As I say, 80,000 ounces, $800 operating, that's roughly $60 million of EBITDA. And we can keep that going, we believe, from inferred resources quite a bit longer. So obviously we can't include those inferred resources in the mine plan, but we've always had resource conversion over time. The mine's 114 years old, so we're quite confident we'll keep going deeper and deeper. And the question then is, what do we do with that money, right? Currently the dividend costs us about $3 million. So our 3% dividend yield is about $3 million a year. We are operating, we believe, in the last gold frontier in Africa at the moment. This is a region that used to be the 3rd biggest gold producer in Africa, behind Ghana and South Africa. There's plenty of gold there. There's a long history of gold mining. That greenstone belt that you're looking at, can't really do the pointer. That greenstone belt is about the size of Burkina Faso, right? And it's had no investment for at least the last 30 years, and we think practically quite a bit longer. Really, probably back. You can go back to the Civil War. There was a brief honeymoon period in the 80s where Zimbabwe had some investment in the early days of the Mugabe government, but really since the 90s there's been nothing, and in the 70s there was a civil war. So there's a lot of gold there, and we feel, frankly, we're in pole position to go after that and invest in this region. Zimbabwe is challenging. I don't need to tell anybody that. Politically, the environment is difficult. The economically, things are tough. I can't go into all the details here, but we do see grounds for optimism. Certainly, since the new government came in, we've noticed a substantial change in the attitude towards business. They've scrapped indigenization legislation, for example. We announced earlier this year that we'd completed a transaction to unwind some of that indigenization and roll some of those indigenous partners up to the top company. So it's not for the faint of heart from an investment risk perspective. But frankly, we believe that risk is mispriced, and mispriced risk is where you can make money in this industry. So I think, in summary, we have 14 years of pretty high margin operations, good cash flows. We're very excited about the shaft. We think the asset in and of itself is mispriced, and then we're operating where we believe, a fairly unique competitive advantage in one of the most attractive gold exploration areas in Zimbabwe, in Africa, and we're quite excited about that. So. Almost perfectly on time. Thank you for your attention.